What's up, everybody? My name is Luke, and this is going to be the first video for a new channel I am making. It is primarily going to be about finances and money and investing and stocks and everything kind of in that world. I don't even know what I'm going to call this channel as of yet, but I've been meaning to start this journey of documenting my progress and just my financial life. I'll give a little background about me, since if you're watching this first time you're meeting me. I am 25 years old. I live in Southern California. I bring in an average amount of money for my age in the area, nothing too crazy, but I am very dedicated to investing and saving and trying to build wealth. I live pretty cheaply. I mean, I wouldn't say I go crazy overboard, but I do my best to save money where I can and just be fiscally smart. So getting into this today, we are going to be looking at my Robinhood portfolio. I've been on Robinhood for some years now. I think I started investing in 2020, but I didn't really take it seriously till 2023. That's when I started consistently investing every month. Actually, I just made it automatic, and that's kind of what really started me being consistent in investing. And my overall philosophy right now is I'm trying to build a portfolio of dividend growth stocks where I do receive a significant amount of dividend income, but I also see some share price appreciation. So I kind of have a mix between high yield dividend stocks, growth stocks. There's a couple of non-dividend stocks in this portfolio. But let's just dive into it. As we can see, my portfolio is sitting at $26,400 and some change, almost at $26,500. I think overall there's about 20-ish stock positions and a couple of really tiny crypto positions. But breaking it down, let's just jump into the stock positions. So one of my biggest positions is going to be Realty Income. Realty Income is a REIT. It is a monthly dividend payer. There's not a lot of monthly dividend payers. Realty Income is kind of like the main one. I have $2,200 and some change in this, with an average cost of $55.62. I am currently up 14% and some change, and it's probably one of my biggest positions, where I have it at 8.56% of my portfolio diversity. Currently, Realty Income every month pays me about $9.50. I really would like to get this position higher, but I don't really feel comfortable buying in when it's at this price in the low to mid 60s. If it ever drops down again, I definitely want to scoop up some more shares, but for now, I'm happy with where it's at. Moving on, we have Walmart. This is a small position I have. Honestly, I bought it a while back. I got it for super cheap, $77.47. Although when I bought it, I never really had any conviction behind it and didn't put a lot of money into it. So I only have 1.8 shares, although I have a 65% return, which is pretty insane. I really should have bought more. It saw a pretty big jump lately after there was the AI pullback, and a lot of consumer staples were shot up because of people viewed them as safe bets to park their money. Maybe I would consider buying more Walmart, but if you're gonna see later, I have another stock that's very similar to it, which I have a significant amount of dollars into. Moving on to stock number 3, I have Vici Properties. This is a REIT, primarily Most of their premier properties are in Vegas. They have a great occupancy rate. They have a yield which is sitting at 6.27% is what I have on Robinhood. I have 31 shares at $29.65. So currently I am down 3.5%. I think though with dividends, I am slightly just over break even. I will pull up my Snowball analytics. I'll pull up my page and it'll see the exact return. It's another just investment tracker platform that I use. I'll pull that up in a bit and I can get some more detailed information. But Vici is a really great REIT. They have a good yield. They have a great balance sheet. There's a lot of sentiment right now about Las Vegas itself and how the city's in decline and how not a lot of people are going there anymore to spend money, and it's just kind of turning into an overpriced tourist trap. It's not like it used to be. I don't know. I mean, I've been there myself. I see it, but at the same time, Vici properties, their balance sheets don't lie, and all their tenants are making rent. The casinos. So for now, they're a hold, and maybe I'll add to it at these since I am in the red technically, and just lower my average cost. But we'll see. We'll say it's a hold for now. Moving on to stock number 4. We have Chevron. It is currently April of 2026. Chevron went on a massive tear after the Iran war. All the oil and energy stocks really popped up. In the last 3 months, Chevron's up 18%. It's actually fallen a little bit. It peaked at $211, but currently it's at $188. I have 4.47 shares of Chevron, and I am up 31%. I only have $842 in value of Chevron, and I'm not going to be buying at this price. But I think it's good to always hold some oil and energy stocks, and Chevron is a great oil. It's a great oil stock. And on top of that, it's a great dividend pair with the yield currently. Robinhood says 3.74. I think it was a little higher, but since they ran up, the yield has gone down. But Chevron is a hold for now. I'll just keep taking that dividend. Moving on to stock number 5, we have SCHD. This is the first ETF in my portfolio, the Schwab US Dividend Equity ETF. If you know anything about stocks, or especially dividends, you've probably heard of SCHD. It's a great ETF for dividends. I have a lot of money parked in there. It might be my biggest position at 8.74%. I have 73 shares at an average cost of $26.42. I'm up 18%. With dividends reinvested, it's probably gonna be in the 20s on the return. SCHD is a great ETF. They update it every year. They kick out. There's a strong criteria for that companies need to have to be included in the fund, and it's updated every year. I think they just went through their March reconstitution last month, and they added some new stocks. I think one of them, I'll talk about it later. But SCHD is a great ETF to own. I should buy more of it, but I've honestly been buying more individual stocks as of the last few months. Moving on, we have Johnson & Johnson, ticker symbol J&J. Johnson & Johnson I bought pretty early when when I decided to start dividend investing. I have an average cost of $148.57. I have 2.9 shares, only $664 in market value, but I'm up 53%. And with dividends invested, it's going to be a little more. Johnson & Johnson is a bulwark in the dividend community, a very safe stock. They make a lot of consumer staples. However, at these prices, I'm not sure if I'm comfortable buying more. I haven't bought this position in a long time. It's a very small percentage of my portfolio, about 2.5%. But I'm totally okay with holding it. I'm not worried about this company in the slightest. They do have a decent yield at 2.31%, and I know their balance sheets are looking very good. So moving on, I think this is what stock 7. Yeah, 7. We have EPD, Enterprise Products Development. I don't know what the D stands for. EPD is a pipeline. It's a energy oil stock. I think they classify it as a utility, but I think they're primarily just an oil pipeline stock. I have 25 shares, an average cost of $28.70. I am currently up 33%, and I have almost $1,000 in this stock. Year to date, the company's doing pretty well. They saw a benefit from the Iran war with the energy boom. They're up 20% year to date. This is another one I'm not worried about. They have a great yield at 5.69%. I know I get a pretty significant dividend off of them. However, I haven't been buying into EPD in a long time, but I'm very comfortable owning them and holding them for now. And if they ever drop, I'd love to acquire some more shares. Moving on, past EPD, stock 8, one of my favorite stocks. We have Altria Group, ticker symbol MO. They are a cigarette company. I'm pretty sure they're Marlboro. Is it a very ethical company to own? I don't know. I don't really care about the ethics of buying stock. However, they have been paying a dividend for, I think, over 50 years, making them a dividend king. And their yield, despite them being in this high 60s right now, they've had a great yield. Right now it's at 6.36%. However, I think when I bought them, because I bought them in the low 40s, my average cost is $47.22. I think my yield on cost is much higher than 6%, probably closer to 8, 9, 10%. Overall, I'm up 43% on Altria. They're one of my bigger positions. I have almost $1,300 in this position. They make up just about 5% of my portfolio, and they have a pretty juicy dividend. I think I get about $20 every quarter. $20 may not sound like a lot, but to me, $20 is a lot for doing absolutely no work. And just having such growth in a high-paying dividend stock, this stock is awesome. Although where they're at right now, I don't think I'm ever going to sell this company just because of the dividend, but I feel like they're at a pretty premium valuation in the high 60s right now. But yeah, Altria is one of my favorite positions I have. I wish I had more and wish I bought more back in 2023 and 4. Moving past Altria, what was that, 8? Stock 9? All right. We have our second ETF, VOO. Not much to say. If you know anything about stocks, you've heard of VOO. It's just an S&P 500 ETF. It's one of the bigger positions. Makes up about 8.42% of my portfolio. It's about the same size as CHD. They used to be more, but I really just haven't been buying ETFs lately, although I probably should, just for stability and some diversity. I have 3.4 shares, and I'm up a total of 29%. Grand total, I have about $2,230 in this position. I would really like to have more, but it's just, I keep finding better buys, I feel like, when it comes to individual stocks I want to buy, but it is on my mind to buy more and contribute more. Moving past VOO, I'm gonna kind of breeze over it just because there's not a lot to say about it. For now, we have Nvidia. Nvidia I bought, I think, at the tail end of 2023. I have 4.39 shares at an average cost of $115. They are at $212, so that's a pretty good return. I'm up 85%. Damn, I should have bought more. They're not really a dividend payer. They pay like 1 penny per share, so I get like 4 cents every quarter. So it really isn't a dividend payer, but it's a growth stock for sure. I have almost $1,000 in this stock. I really don't feel comfortable buying any more at this position. I've been focusing on some other tech stocks as of lately, but Nvidia is a great company, one of the Mag 7. And maybe if it has a pullback, I'll consider buying more. But as of right now, there's some other tech stocks I'm focusing on. Moving past Nvidia, we have Visa, ticker symbol V. Everyone's heard of Visa. They're a payment processing company. If you have a debit or credit card, you might see the little Visa logo. They handle so many trends. They're basically a duopoly with MasterCard in terms of payment processing systems. They have an amazing balance sheet. I wish I bought more of them. I only have 1.65 shares. They make up less than 2%. I'm only up 4% on them. However, I would totally love to acquire more Visa just because of their balance sheet is so strong, and I really can't see any competition or disruption into their business model in the near future. It's just a great company. They have a very low yield at 0.81%, so I get a couple bucks from them every quarter. But in terms of if I did acquire more, that would go up, and I'm totally okay with having them as a high growth company. Also, that they grow their dividend at a very strong rate, I know, every year on year, and they've been growing it for the last couple years pretty significantly. Moving on past Visa, we have U, ticker symbol U. This is an interesting company. It's called Clear Secure. I have 20 shares, an average cost of $25.65, and they're at $53.78. And if you do the math, you know that I am up over 100%. That's a whole 100% return. U is like a security company, I guess. I don't know really what to classify them as, but they handle they basically, they're the company that does like TSA pre-check, and they have like a partnership with like American Express where people get access to TSA pre-check for sure, and they just have a pretty good business model. I know Americans really hate waiting in line at the airport, and they recently had a crazy run up. In the last 3 months, they're up 56%. So I'm up over $572 on this position. They are about 4% in my entire portfolio, and their yield has gone down significantly since the run up. They're only at 0.96, so about 1%, but I'll take it. Great growth with a small dividend. Wish I would have bought more, but it's okay. Moving past you, we have AGNC. Honestly, I don't really know why I still have this in my portfolio. I know it is a monthly dividend payer. I'm pretty sure it's a REIT. Yeah, they really don't make up anything in my portfolio, about 1%. I have an average cost of $9.07. They're currently sitting at $11.08, so I'm up 22%. I probably should sell out of this and just put the money somewhere else, but I don't know. They've just been sitting in my portfolio collecting the dividend. I think it's like $3 every month. Honestly, I don't have much to say about this company. Their yield's off the chart, like 13%, but since I only have like less than $300 in there, about $275, it really isn't that much. Yeah, that's probably on the short list for possible sells in the near future. I haven't really looked at their financials as of lately, but I'll look into them some more and do a reevaluation. Moving on past AGNC, we have Lockheed Martin, ticker symbol LMT. If you know anything about the defense industry, you've heard of Lockheed Martin. They make some of the most crazy aircraft and airframes that the world's ever seen, like the F-22 Raptor. They are a major defense contractor. Oh, and the F-35, the newest one. I think the F-22 is cooler, by the way. But Lockheed Martin, major defense contractor, has decade-long contracts with the U.S. government and many other governments to produce the F-35. With the recent Iran war, they saw a pretty big surge. However, in the last week or two, they've pulled back. They're currently sitting at $512, and on the week they're down 12%, $70, and on the month they're down 16%, $100. They hit an all-time high, or a yearly high, of 676. Probably should have sold and took some profits, but that's okay. I'm in it for the long run on Lockheed. I have 2.57 shares at an average cost of $450. So currently, despite all the pullbacks, I'm still up about 13%. They make up about 5% of my portfolio, and I'm totally cool with having them. They're one of my bigger positions, I would say. And they pay a pretty decent dividend, nothing too crazy, but not too small, 2.63%. Honestly, I think Lockheed's one of my favorite companies just because I think they're cool. You know, I used to be in the military, a little trivia, and ain't nothing cooler than a fighter jet. I've seen them in action. They're pretty dope. So I don't think I'll ever sell out of Lockheed. I'm a believer in the military-industrial complex. Say what you want to say, but I don't think it's going anywhere anytime soon. So neither is Lockheed in my portfolio. But moving on from LMT, we're getting into some of my more recent acquisitions. We have JP Morgan or Chase Bank, ticker symbol JPM. It's the largest bank in America, I think possibly the world. They have a pretty interesting history that goes back many decades, maybe even hundreds of years, to their founder, the JP Morgan. Not a huge position in my portfolio, want to make it bigger. I currently have 2.6 shares at an average cost of $252. So they only have about $800 in value. I'm up 23% on them, and they only make up about 3% in my portfolio. You know, what can I say? I like having companies that I am familiar with and know how they make money. And I mean, I bank with Chase for just my checking account. You see them everywhere. I think they're in every single state. You're gonna see a Chase Bank on the corner. Add some good diversity to the portfolio with having some financials and banking stocks. And they're just such a big company. I have absolute faith they're going to be around in 50 years still. I mean, they were bailed out in 2008. I'm sure if anything happened, they'd be bailed out again by the U.S. government. But we've seen some good returns on them, 23%. They pay pretty decent. Yeah, it's okay dividend, 1.86%. Just to me, they're just a feel-good company, kind of like Johnson & Johnson. I don't have any, I don't lose sleep over owning JP Morgan. And they pay a little dividend, which is nice. So JP Morgan is definitely going to be staying in my portfolio for the long term. Moving past JP Morgan, we have ticker symbol TGT, Target. One of my proudest plays I made recently, Target stock. I have 11, almost 12 shares of Target, an average cost of $93. They are currently at $127, and I'm up 36%. I bought Target in April when there was the tariff scare. I forget what they called that day. There's like a name they called that day when Trump brought out the whiteboard and the whole market crashed for like 2 days. There were a few companies I bought that day. Target was one of them. They dropped down into the low 90s. I think even they hit high 80s at one point. And Target's one of those companies where I know how they make money. They sell stuff. You know, I go to Target all the time. I know people that go to Target all the time. It's Target. They're like Walmart. That's why I said when I was talking about Walmart, I have another similar company. They're Walmart's competitor. But at the time, they were battered down, their stock price, so much, I thought it was a good value play when they dropped down into the 90s. Because if you look at their 5-year chart, they were sitting in 2024, 160s, 170s. If you go back to 2022, they were 230, 200, 250, you know. So when they dropped down into the high 80s, low 90s, I thought this is a good value play. And on top of that, their dividend yield, they're also a dividend king. I think they have over 50 years of consecutive dividend payments without a cut. And their dividend yield was, I think it got all the way up to like 5-6%. So I locked in that yield when I scooped up some shares, and they've been on a turnaround play lately, and I'm now up 36%, probably close to 40 or 40+% with dividends, with that good yield. Because unlike Walmart has a pretty small yield. Target was paying upwards of 5% on their dividend yield. So at this point, Target is hitting some pretty good share price gains. In the last week, they hit $133. I considered selling some and taking some profit, but I don't really think I'm in the taking profit investor. I'm thinking I'm more just a very long-term investor and just collecting dividends as well as appreciation. However, I don't know. My gut feeling tells me Target's not going to stay at these prices, and it's probably going to pull back. But what do I know? But moving past Target, we're getting towards the end here. We have United Health Group, ticker symbol UNH. If you know anything about healthcare or insurance, you've heard of United Health. They've been in the news lately. The CEO that was assassinated by Luigi Mangione, that was United Health CEO. Say what you want about me owning unethical stocks, like cigarettes and defense contractors and American health insurance giants. If they make money, they make money, right? And United was the other company I bought in April 2025. When they dropped down into the 260s, 270s, I got them at, right now my average cost is at 283. I've dollar cost averaged up. I think I initially bought them in the 260s. It's one of my bigger positions. I have almost 6%, over $1,500, and I am up 30% on this company. With dividends reinvested, it's going to be well into the 30%. I have 4.15 shares. They have a pretty decent yield. I think my yield on cost is in the 3%. Their yield on Robinhood says 2.49. But in the last month, they are up 42%. So we've had a pretty good month with them. And year to date, they're up 10%. I am very comfortable owning United Health. They are a bulwark in the American healthcare system. And I think on the latest SCHD reconstitution, they were added into the SCHD fund, as well as I think Warren Buffett bought United Health and put it in his own portfolio. And I trust that guy's judgment way better than I trust mine. So long term, I think United Health is going to be a pretty good play. I probably would just continue to buy a little here, buy a little there. I think there's a great company overall. I know there's a lot of concerns about United when it comes to like Medicare and how much they're gonna, if there any of the changes to like Medicare and stuff would affect their business model. But lately, I think the panic in the investing community is what drove that down. Also, they had really shitty earnings, and their guidance was lowered. That's why they fell so much. But as of lately, the sentiment around the company has been pretty good. So, or you keep riding with United for the next long while. Jesus, we're already at 30 minutes. I gotta wrap this up. This is gonna be like a 40-minute video. Okay, next stock. Blue Owl Capital Corporation, ticker symbol OBDC. Blue Owls and OBD is a business development company. They pretty much lend money to small and mid-sized businesses with interest to develop them, and then they get returns. I think by law they have to pay out a very large percentage of their revenue as dividends. So they have like a 13% yield, and they recently pulled back a lot over the last year, or since the beginning of the year. I have over $1,500 worth of this company. I have 138 shares, an average cost of $12.13, and they're currently sitting at $11.35. So on the share price, I am down. I was trying to catch the falling knife. I bought them on the way down. They kept dropping. That's okay. With a yield like 13%, they pay an insane dividend. They are my highest paying dividend company. I just received the last quarterly dividend. I think it was like $45. So I think total I've received like $70 in dividends. So I know long term I will be okay. This is definitely my highest paying dividend position. I'm only down 6% on Robinhood. With dividends reinvested, it's probably like 2%. But this is one I've just been dollar costing into. Since the price is below my average cost, I will just keep buying. It is getting close to a pretty large size position at almost 6%, but that's okay. Anyway, moving on. Let's get this done. After OBDC, we have Zoetis. Zoetis is a pet pharmaceutical company. They basically they're like pet healthcare. And for the longest time, they were killing it, and they had amazing balance sheets. They still do have amazing balance sheets, but after a couple of rough earnings, their share price dropped. They were sitting, I think at their peak, they were hit $170, and ever since then, they've been on the decline after some rough earnings. But their balance sheets are still looking pretty great. They've had great dividend growth over the last few years. And I tried to catch the falling knife with them. I got them at an average cost of $133. I have 11.76 shares. I'm down 12%, which kind of sucks. The dividends reinvested does help a little bit, but this is one of my few losers in the portfolio. That's okay. I think long term this will be fine, and I'll just keep dollar cost averaging. I actually have a dividend pending, $6.21 coming up. So that's cool. But Zoetis, pet healthcare. Americans love their pets. They spend an absurd amount of money on their pets. So I think they'll be a great company in the long run. Moving past Zoetis, we have Meta or Facebook. Facebook, no introduction. They get a lot of money from ad revenues. I bought a significant amount of tech stocks on the latest AI pullback and a tech stock pullback that happened in March and April. All these tech stocks dropped significant 15-20%, and for the first time in my life I started buying tech stocks that don't pay a dividend. Actually, a few of them pay a dividend. So I have 1.09 shares of Meta at an average cost of $600, and I'm already up 11%, which is awesome. I want to increase my position on this one. I think for some of the AI plays, Meta is probably one of the best ones. They have a lot of investors are very fearful and have a caution to their CapEx spending, their capital expenditures. But in terms of Facebook, there's companies that have a large CapEx like Verizon, AT&T, where they have to keep spending money just to maintain. They're spending all this money upgrading their towers and shit just to maintain their service. But companies like Meta and Microsoft and all these kind of like AI play tech giants, their capital expenditures are rising, but the possibility for a return on this money is significant. It's not like maintenance CapEx spending. It's like they're investing in their own company for the chance of possible returns. So Meta is a great one, and I am very bullish on Meta. Moving past Meta, we have Amazon. Amazon, no introduction needed to Amazon. They have a super diverse company now with Prime Video, AWS. They're getting into robotics. Some might say Amazon could be a little bit of robotics play, AI play. Very diverse company, very strong balance sheets. One of the laggards in the Mag 7 in the last year or two. But I also saw that they were pulled back so much. I bought a little over 2 shares just in the last few months, and I'm already up 25%. I wish I had more conviction and put more money into these tech stocks when I saw this opportunity in the last few months, but that's okay. I do want to acquire more Amazon. I think they're one of the most, best companies out there right now, and I'm very bullish on Amazon too. Moving on, we have CRM. This was like the first tech stock I bought in the pullback. Salesforce, CRM. How do I even explain CRM? I don't want to say anything that's wrong, but they're just like a business logistics. Like businesses use Salesforce as part of like their internal systems to like run the companies. I don't think it's payroll, but it's kind of like everything else. Maybe like I don't even want to say anything wrong. But Salesforce was a giant among kind of tech and financial stocks. But they had a lot of pullback on fears of AI just completely obliterating their business and making it obsolete. However, their balance sheets are so strong, and companies that already use Salesforce products, from what I hear, is they are so integrated already into the Salesforce ecosystem where it'd just be almost impossible to get rid of them completely. And they have contracts, and their balance sheets are still looking great. And I want to say they're due for an earnings report very soon, so we'll see on them. I put a lot into this one. I have about 6.25 shares at an average cost of $195. They're sitting at 181, so I'm down 7%. They do pay a little dividend, nothing crazy, just under 1%. I do not know how to feel about Salesforce. I do not know if it's going to turn around or not. This one's more just kind of like a gamble and hope that they do. We'll move on though. We'll talk about it later. Maybe another video. Definitely going to be more videos coming out, guys. If you're still watching this, thanks, I guess. It's kind of fun talking about stocks, but we're getting towards the end here. But appreciate you watching if you're still here. Second to last stock, Microsoft. No introduction needed. AI pullback, same as Amazon, Salesforce, and Meta. I have 1.57 shares. I'm already up 10%. It's Microsoft. They make great products. All the Word subscriptions, Xbox. They're getting into AI. Just a bulwark in the financial tech stock space. And I'm very bullish on their AI prospects. And people are concerned that they have too much of a reliability on OpenAI. But I'm going to bet that in the long run, they're going to be just fine. And they do pay a small dividend, just under 1%. They saw a good pullback too in the last year, down 11% right now. But I'm looking for a great turnaround on them. Wish I would have bought more. I think for all these ones, I kind of bought the same amount, except for this last one. I really just bought a couple bucks worth. This last stock is going to be Google. No introduction needed. It's a Google. They own YouTube. They own a lot of stuff. They get a lot of ad revenue. Great balance sheets. AI play currently right now. I got in at 298 and they're currently at 350. So that's a 16% gain. The problem was I only bought like 80 bucks. So they're really, I don't even know why I bought it. Probably should have put that 80 bucks just into Facebook. But I think I just wanted to have it, just to say I have it. I don't know. They do actually pay a dividend, about 0.25%. So this is gonna give me a couple pennies. But we own it. Maybe I'll sell it and just put that money into another position. But we'll see. So I think that makes up all my individual stocks that I have in this portfolio. And on top of that, I have, I think like $500 in Bitcoin. So Bitcoin's like 2% of my portfolio, just to have some crypto exposure. And I'm actually down on Bitcoin, like 9%. My average cost is 84K and they're at 76K. Let me pull up my Snowball. Snowball is a investment tracker that I use. I pay a couple bucks for it, but it is super worth it because they tell you your returns with dividends invested, which is pretty awesome. Yeah. So Snowball has me up a grand total of 21%. I'm up 21% on this portfolio, which is pretty good. I know for a fact I'm beating the S&P 500, which I'll take it. I'm not really a genius, so if I can beat the S&P by 1% or 2 every year, I will 100% take that. What else can I show you guys on Snowball? So my total dividend yield for this entire portfolio is 3.41%. I think that's pretty moderate. I don't think that's too high. I don't think that's too low. And annually, I am getting $904 in dividends per year, which I think is awesome. Really trying to hit that $1,000 mark and get a K a year from dividends. That's just kind of been my goal for the last little while. But it's pretty awesome to get $900 in dividends and just receive some cash for doing absolutely nothing. Like $900, that's like 2 car payments or like a good amount of grocery trips, you know? So I'm definitely interested in growing that. I think my target for the end of the year, I'm gonna be a little aggressive and say my target for end portfolio value is 35,000. I think I can do it. We're at 26.5 right now, but we'll see. It's already May basically, so we're gonna be pretty aggressive in this. But that's kind of all I got for this first video. We're coming up to 43 minutes, but I just wanted to share my portfolio. I definitely want to be making more videos on not just my portfolio, but like all my assets, maybe show my net worth and just a lot of good financial videos and stuff like that. But yeah, guys, thank you for watching. If you're still watching, appreciate it. And I'll see you guys on the next one.